Wall Street cheered last week as inflation numbers cooled, fueling hopes for a soft landing, taming inflation without a recession. But this optimism is premature. The economy is far from predictable, shaped by global events and shifting consumer behavior. Declaring victory based on a few positive data points ignores deeper, persistent risks. The idea of a soft landing is comforting, but it's not guaranteed. Higher interest rates, the main tool to fight inflation, are risky. They slow growth and can easily tip us into recession. The line between slowing inflation and triggering a downturn is razor thin. Wall Street's excitement risks breeding complacency just when vigilance is needed most. Inflation isn't defeated, it's evolving. The risks haven't vanished, they've changed form. For investors and households, understanding this is critical. The soft landing story is easy to sell, but the reality is a prolonged, uncertain struggle. We must approach market optimism with skepticism. The cheers may be drowning out warning signs. The fight against inflation is entering a new, more complicated phase. Last week's Consumer Price Index report sparked a market rally, but headline numbers can be misleading. Core inflation, excluding food and energy, remains stubbornly high, driven by rising service costs like insurance, healthcare, and dining. These prices are sticky, tied to wages and a tight labor market, and don't respond quickly to interest rate hikes. Shelter costs are another major concern, with housing expenses climbing steadily. High rates make it harder to build new homes, worsening affordability and keeping shelter inflation elevated. The inflation battle has shifted from supply chain issues to entrenched service and housing costs. These problems require long-term solutions, not quick fixes. Celebrating a single good report ignores the persistent underlying pressures. The market's relief is premature. The real economic storm, core and shelter inflation, still rages. Ignoring these realities is dangerous. The path to lower inflation will be slow and challenging. The Federal Reserve isn't rushing to cut rates, despite market hopes. Officials now expect just one rate cut next year, not three. The Fed wants clear, sustained progress on inflation before easing policy. This cautious approach clashes with Wall Street's desire for quick relief. Investors betting on rapid cuts risk disappointment and market volatility. The Fed remembers the 1970s, when cutting rates too soon reignited inflation and led to deeper pain. Powell and his team would rather keep rates high than repeat that mistake. This means slower growth and continued high borrowing costs for households and businesses. The Fed's patience is a test for everyone. Relief is still distant. The market wants a sprint, but the Fed is running a marathon. Accepting this reality is key to preparing for what's ahead. The waiting game continues. High interest rates are hitting the housing market hard in both the US and Canada. In the US, high mortgage rates lock homeowners in place and keep supply low, pushing prices higher. First-time buyers face steep barriers, widening the wealth gap and delaying life milestones. The housing market, once a ladder to prosperity, now feels like a wall. In Canada, most mortgages renew every 5 years or less. Millions who locked in low rates during the pandemic now face payment shocks as renewals approach. This could trigger forced sales or even defaults, threatening the broader economy. The Bank of Canada faces a tough choice: cut rates to help homeowners or risk importing inflation. For families in both countries, housing has become a source of stress, not security. The fight against inflation is creating real-world pain. The crisis is building quietly, but its impact could be explosive. The stability of homeownership is at risk. The U.S. labor market looks strong on the surface, with solid job growth and low unemployment. But dig deeper, and cracks appear. Much of the job growth is in part-time work, while full-time positions stagnate. More people are juggling multiple jobs just to get by. Jobless claims are quietly rising, a classic early warning sign. Companies are trimming at the margins, signaling caution. If this trend accelerates, unemployment could rise quickly. The labor market's resilience may be overstated. Consumer confidence is fragile. A weakening job market could quickly derail the soft landing narrative. Stable jobs are the foundation of a healthy economy. The data suggests that foundation is shakier than headlines imply. The risk of a downturn is real. Beyond official data, gold and oil prices reveal market anxiety. Gold is near record highs, signaling investor fear and a lack of trust in everything is fine. Rising oil prices threaten to reignite inflation, squeezing consumers and businesses. The combination of high gold and oil prices is a warning. Instability and inflation risks are rising. Canada's recent rate cut, ahead of the US, is a gamble. A weaker Canadian dollar could import inflation, undoing progress. The Bank of Canada is walking a tightrope. Wall Street's optimism is built on selective data. Inflation remains stubborn and unpredictable. The Fed is right to be cautious. Housing and labor market risks are growing. This is not a time for complacency. The smart money is preparing for a long, bumpy road ahead.